And those that are generally interested and curious about the crypto and blockchain space, we like to, with Tech Frontiers X, we like to present content that is centered around and hopefully beneficial to founders and those seeking to break into the world of crypto and blockchain. Today, I am your host, Zach Atkins, and this is the Tech Frontiers X podcast, a venture started by Pierre, the CEO of Galileo Protocol. I always mess up his pronouncing his last name, so we'll attempt it, and I apologize in advance, Pierre, but it's Pierre Bernardo, and he is our fearless leader at Galileo Protocol, and I have been blessed that I have the opportunity to host a second time for the Tech Frontiers X podcast. I am incredibly excited about the topic today. It's something that's very near and dear to my heart. It's something that I have studied a lot over the years since I first found out that it was a thing. And so I get to talk about it a little bit today. So welcome, everyone. And we're grateful that you have tuned in. These are always fun. They're very interesting. You never know where a solo show will go because in my case, I tend to ramble and then my mind will catch a thought and we'll start running with it. We eventually get back to the content, the source of the content, or the source of the thought, but it tends to wander a little bit. So you can see a little bit of a glimpse of what my mind looks like and how it processes things. And then, it's just fun to get to talk about these topics that are pertinent to the world of blockchain and crypto. Specifically today, we're going to be talking about venture capital and crypto. Like I said, it's something that's near and dear to my heart. I'm very excited to get into a little bit of insights about the current state of the industry, some social proof that goes along with it, as well as some red flags. And then finally, if you are a founder, you're listening or watching this, some takeaways and some action points that you can add to your toolkit, and hopefully it can equip you on your journey through the startup world. First, though, I want to discuss and kind of wrap up this exciting event that we had this past week. If you're listening to this at the time of recording, then we have just completed SmartCon. So it's Chainlink's SmartCon, jam-packed with some incredible speakers and leaders in the space, and not only just in the crypto space, but also in the world of AI. And you've got the former Google CEO who was a keynote speaker and was part of some of the panel discussions. You had people that have cut their teeth in the traditional tech world, the Web 2 world, if you will, that were speaking there. And then you had a lot of innovative and I would say a combination of leaders as well as visionaries or early stage leaders, soon to be names in the world of crypto and blockchain that were leading keynotes, discussing things from Chainlink, CCIP, interoperability technology, as well as I believe they launched a product called Data Streams. I haven't had a chance to look into some of those, the tech side of things yet, but I definitely will be looking into it, seeing just the benefits of it. But then we had keynotes on DeFi and your main crypto topics. But one of the more exciting things, especially being connected to the Galileo team, is Pierre's keynote. He had the opportunity of giving a keynote speech on AI and NFTs, and specifically in the context of luxury goods, because at Galileo Protocol, that is our niche. That is the genre that we are breaking into, and that we have built partnerships and clients, uh, different brands in the luxury goods industry, exotic cars, things like that. So that keynote had both, or a combination of live as well as people that watched the recording, over 10,000 views. So that's very exciting, as an early stage company, to get at least 10,000 eyes on the product and the solution that you are presenting to the crypto space. Galileo as a company, we had tons of people come by the booth. I have a list of 40 plus connections of people that are interested in partnerships or client relationships. It was, I unfortunately did not get to attend. However, it was reported that the Galileo booth was the most popular booth. And I haven't been to, well, actually, I have been to a crypto conference, but it's interesting because I come from the world of swimming pools. I came from the pool industry. I owned and operated a swimming pool service company and repair company, and those conferences are drastically different than the tech conferences. And so I was very impressed to see the booth set up, and how clean and just pretty everything looks. So we had an awesome booth. Apparently, a ton of interested um, people came by, and we exhibited our fair lottery system using one component of Chainlink's technology, their VRF system. So we were able to conduct a giveaway using the fair lottery system. We call it the internal giveaway because it was for those that were present at the conference. There again, if you're watching this at the time of recording, there's an external, we'll use air quotes, external giveaway going on for those that want to fill out the form and be a part of that giveaway. So I believe it ends the 12th, maybe the 20th. I think we just extended it. So if you're watching this as at the time of posting, be sure to follow Galileo Protocol and find that form for the lottery system, so you can be part of that giveaway. And lastly, maybe the thing I was most excited about leading up to SmartCon is we unveiled DefMix Porsche to the world. For those that were in attendance, you may have been able to see the mysterious DefMic. He's one of our partners at Galileo. He's an artist that, in my opinion, has some incredible artwork, and in the form of traditional art that's on the wall, but also his landscape, or his uh, primary form of artwork in this sense is the Porsche 911 that he completely redid the exterior, and you can actually now bid on it. So we launched the bidding at SmartCon, and the world now can begin to understand what PNFTs are, what they look like, and how that the marketplace will operate, how bidding systems will operate on the blockchain. So very excited for that. If you are not familiar, I encourage you to look on Instagram. Go search DefMik, DEFMIK, and you'll notice why I use the word mysterious, or why I use the word unveil, because you won't see his face. It's very similar to the um, the genre of Banksy, where the artist is a mystery. So have a little fun with that. Go explore DefMik and his artwork, and I hope you're as amused and mesmerized as I am by all of it. So, without further ado, let's get into the core topic of today, which is venture capital in crypto. As I mentioned earlier, we're going to talk about the current state of crypto or a venture in crypto, how it differs from the traditional world. We're going to talk about, and in conjunction with that, mention social proof and the different, we'll say, big and big by multiple billions in venture funding, venture firms and traditional venture firms that are all breaking into the crypto space. They all have funds designated for crypto. I neglected to mention we're going to define it first, to define venture and what that is if you're not familiar. We're going to talk about red flags because I think as a founder, uh, one of the most important thing, sometimes a no is way more important than a yes. And actually a lot of times a no is more important than a yes. So you want to, find red flags anytime you're conducting diligence as a startup or as a founder of a startup. And then lastly, we're going to give you some action items. What are the primary drivers for the venture firms are looking for? Um, and we'll wrap everything up with a nice neat bow. Hopefully it all comes together and my mind doesn't wander too much. The topic of today is incredibly pertinent as it pertains to Galileo specifically, because last week or 2 weeks ago, towards the end of the week, I believe it was a Friday, Pierre sent out a message to the community. First of all, it's unique that a founder would be as transparent as he was, as maybe vulnerable with communicating something of this nature. But the message, uh, the basic premise was that at Galileo, we've been in discussions with a venture capital firm to uh, have provide a source of funding. And Pierre will say it's every entrepreneur's dream to have this sum of money presented to you and have the opportunity to have your company affirmed in a sense with a large sum of money. He even provided the number. They had an opportunity, or we had an opportunity to have a sum of a anywhere from the range of $1 to $10 million. And the announcement to the community was that we actually, through our due diligence and in an effort to uh, continue that trust that's been built with the community, in a sense to show and reveal that how valuable the community is to Galileo, we decided it was in the best interest to not pursue this source of funding. And so in this case, the no was very important, and it was really cool to see him be transparent with the community about that decision. And I want to also state that in this podcast, none of what I say has been uh, take what I say with a grain of salt, but the my viewpoints are my own, and this isn't and by no means an attempt to fluff the Galileo protocol or to provide something like none of these thoughts have been directed by the team or anything of that nature. This is my personal viewpoint on it all, and um, I've shared that with Pierre and Nathaniel, the co-founders. Um, but I was incredibly proud of this decision, um, based on the discussions we had internally. Um, it was clear that it was a good decision, and I was proud that they could see. I mean, imagine someone dangling $10 million in front of you and then saying no. And that's what they had to do. That's a very hard decision, and it built or gives me a lot of trust, and um, it shows in a sense that they're real. Like, they're in it for the long haul. They value the community, and you know, a lot of I had a friend back in the day. He would say people get weird around money, and that is it's very true. And most people lose sense, all sense when they're presented with a large sum of money, or have the opportunity to have a large sum of money. Think about the lottery and what people do when they win it. Oftentimes, it's way worse for them than if they had never won it at all. Um, but I digress. So, all of that to say, I'm very proud of the decision. I respect it a ton. It takes a lot of foresight and vision, and um, confidence in the technology you're building and the community you're building it around, to say no to that sum of money. So that's kind of that was top of mind as I was thinking through what sort of content that we should provide today on the podcast. And having said that, let's get into venture capital and crypto. First of all, I'm going to start with the definition, because some of you might not be familiar with venture capital or the financial industry. Private equity might be a foreign term to you, but venture capital is a form of private equity. So, as opposed to public equity like stocks, things that are publicly traded on the open market, you have your private equity, which is typically limited to, almost in every case, limited to accredited investors, institutions, firms. So, venture capital is a form of private equity that investors provide startups and small businesses with high growth potentials. So, they provide funds to startups. I believe I left off funds. Um, and until crypto, you had um, one way of doing things. You had the traditional venture capital model. You had basically most of the deals were done with equity. You had a cap table that would distribute equity to your early stage investors, um, and then that either gets converted if the company IPOs into stocks, or they get bought out. Um, Excuse me, the early stage investors get bought out, or it was essentially equity in the company. So the current state of or crypto changed some of that. There is still equity offerings in these early stage companies. Um, However, now there's this whole element of a crypto token, and there's token offerings. A lot of companies, rather than getting formal venture funding, they went the back in 2017 with the ICO craze. They went the ICO route, and they basically crowdfunded their platform in the form of a token. So there's a lot of regulatory scrutiny going on, and it's kind of the Wild West. We're in crypto. It's the early stage of an emerging industry. It's the Wild West. So yeah, the 2017 ICO craze. While I was not a part of that experience, I have heard stories, and we've since evolved a little bit. But our current state of venture is you'll have either traditional funds that are breaking into venture, or breaking into crypto, or you'll have crypto specific venture firms that start popping up out of everywhere. Um, so standards, kind of, now we have a token and equity combination, rather than equity being distributed. You'll have a combination of the two. Usually it's a 50-50 split, and depending on the needs of the venture firm, if they want to be more liquid, they'll go more on the token heavy side. If they want to um, basically be in it for the long haul, they will be more on the equity side. So that's your kind of current state. Typically, you'll have funds, or you'll have crypto companies that are getting anywhere from the small end of about $1 million in venture funding, all the way up to, I've seen some that are 30 to 40 million in funding. Now you've got other traditional Web 2 companies that typically have, I'd say typically, your large fundings can get all the way up to your 500 million or your billions in funding. But not crypto, not yet. We are a very immature industry, immature market, and firms are navigating and trying to figure out the value of a token, the value of a currency, um, even the value of startups. If you look at your traditional uh, um, or your Web 2 startups, most of them, anytime that the evaluation is put on them. So like if you have a Web 2 company that has raised 10 million in funding, then they put a valuation. So that company, if they went public, the valuation could be placed at a 10x based on their fund their funding. So their valuation would actually be 100 million, uh, um, if they have a $10 million round of funding. That's not the case in crypto. So if you have, and then in your non web related industries or your non tech industries, you have anywhere from like a 3x to a 5x. So if you have like a we'll go with swimming pools. If you have a swimming pool service company that is valued, or that and you raise funds for, um, or excuse me, you have a recurring revenue of an annual recurring revenue of about 1 million, then you would put anywhere from like a 3 to 5 million um, price tag on it, so valuation. So typically it's on the lower end. It's going to be three x. Other industries you'll have a 5x, but in the tech industry you have a round of funding for $100 million, and then that company is considered in their valuation as $1 billion company. I go through all the those gestures and that explanation to say that that's not the case in crypto. Just because a company raises $1 million in funding does not mean that they're then valued at 10 million, or because they raised 10 million that they have 100 million price tag. Because we're a very immature market, very immature industry, and some of those things will become more tangible. I envision long term that once we have formal regulations and clarity on what those are, that then we'll have more standards in the industry, similar to the tech world, where you have um, crypto companies that have real world revenue outside of maybe the token, or that is in some sense combined with the token. Um, and then you got to remember that in all of this whole space, it's largely speculative. And one of the things I love about Galileo is that we are building real, tangible solutions, physical solutions. The whole point of the PNFT is a physical NFT. We have digital representations and the ability to create liquidity, or put liquidity into assets that typically have not had it, or have never had it. So then you have the ability to trade these assets, whether it's a Porsche that's been tokenized and fractionalized, and now you can trade um, based on the value of this Porsche and the artwork that's associated with it. And so there's now liquidity in an asset that didn't have it before. But overall, in general, this space, the whole crypto space, is largely speculative. So, if you are an investor, and this is not financial advice, you want to look at those companies that are creating real, tangible solutions that provide value in the world, or that have an existing, like, real world revenue. One of the things we have at Galileo as well, not to continue down the tooting Galileo's horn, but we have a consulting agency called Hippoly that is real world revenue. It's providing, it's the merging of Web 2 with Web 3 as far as web development, specifically for the health care industry. But there's a tangible real world revenue that is tied to the Galileo network as a whole. So you want to find companies that have those types of real benefits rather than purely speculative NFT projects or companies that have a vision but they don't actually have a product. So enough about the current state. I want to also kind of tie in our social proof. One of the things, even though this is a speculative um, uh, industry, it's a speculative group of companies and assets. We're still trying to navigate, or I say we, the broader financial industry is still trying to navigate how to put values on this. How do you value company? How do you value the token? And there will be a lot of naysayers that say crypto will never reach mass adoption. It's never going to be something that reaches the masses. They said the same thing about the internet back in the day. But then one of the places you want to look to see, okay, what are the trends? What is catching fire? What things are taking off? You want to, in the words of a former president of the U.S., follow the money. So where the money flows, that's where attention is going. That's where value is being driven or value is being placed. If you look at major firms, I'm going to list off a few. A16Z, Angel, formerly AngelList, I believe it's now just Angel or Angel.co. You've got Y Combinator, Bain Capital Ventures, Norwest Venture Partners. A16Z even has a crypto startup school. So you look at these, and these are firms that have billions invested and under management, and you can see the future is there. So you've got traditional venture firms that are staking their claim in this world of blockchain, in this world of crypto. And then, like I mentioned earlier, that you have your crypto specific or siloed crypto venture capital firms that have kind of popped up out of nowhere. And you've even got things like venture DAOs that are, I think, a very revolutionary thing. I think that the venture DAO will provide a ton of democratization of opportunity for these early stage investments. But there's a ton of social proof. I highly recommend, if you're curious, to check out a newsletter called Strictly VC. It will every single day give you a list of what rounds have recently closed, of venture funding has recently closed, and almost every day there's at least one crypto company, if not more. And it's a variety of it's fascinating what is being built out, and it gives you just a lot of faith in the growth of this industry. So we have our current state. We have a lot of social proof that this is the wave of the future. This is where money is going, and the blockchain, provided the right solutions come to place, is the future of technology. It unlocks a ton of doors, and so it might be very easy when you see funding opportunity to take it and run with it. But it's an industry that runs rampant with scams. You have if you've been in the space at all, you've heard of different, we'll say, failings or what we call rug pulls, where early investors had the opportunity to, we call it, dump on the noobs or dump on these later investors. They took their money and they ran with it. That is unfortunately, it's a big problem within the industry. So, and that's not isolated to things like ICOs or the pump and dumps. These happen all of the time with venture capital firms. Lead with that because we're going to discuss the red flags. If you are a founder of an early stage crypto or blockchain company, in order to protect your company, you want to do your proper due diligence on each firm that is proposing or that is offering you any sum of money. The no is often more important than the yes. And so part of that is doing thorough due diligence. So one of the things we're gonna go over now is our red flags in venture, and then specifically red flags within crypto. And you know me, you know that I'm gonna be very transparent with you, and I will state things that you probably already know, but it's just helpful to kind of have that understanding. But if you're not familiar, most podcasters will have 2 or 3 screens up. I do not have 2 or 3 screens, and I like printing things off. So bear with me because I will be checking my notes that I have regarding these red flags, because there's a large number of them. I'm not going to read all of them, but I will read a few of them. And so if you see my eyes drifting off to the side of the camera, that is why. So red flags in crypto. One of them is and especially in blockchain, because blockchain is the counter to that, but it's a lack of transparency. If you are in discussions with a venture firm that is not transparent with the terms of deal, their investment strategy, with the team, with their past performance, I would go ahead and turn and run, because that's going to be a red flag. Another one is an inexperienced team. And I'm specifically talking from the perspective of a founder looking to gain venture capital or funding for his startup. An inexperienced team. It's funny because we're in a world of where everything's backwards. You've got influencers, and I will use air quote influencers, who will comment on life skills, life hacks. They think they have influence, but they lack the life experience. They have never actually lived through they haven't lived enough life to have the experience necessary to be considered wise. So we favor those that are young, those that are slightly ignorant, that think they have these great life hacks, and we don't typically honor the value the wisdom of the older generation. And there's a lot of wisdom that can be gleaned from them. And so I say that because on a lot of these, if you look at these crypto specific venture firms, you'll pull up the team, and it's a group of a couple of 20-year-olds that maybe just graduated college, or they didn't even go to college. Inexperienced team. I personally would not get involved in a team that has not lived long enough to gain the wisdom that's needed in order to run a firm properly. I mean, we saw what happened with Sam Bankman-Fried and FTX and the misuse of funds. Those were just children that had billions of dollars. And we saw the problem that arose. Now there's a lot of things going on behind the scenes that we might not be aware of, or we have a little bit of a glimpse of light on. Um, but they were very inexperienced, and we saw what happened with that. Unfortunately, a lot of people lost a lot of money. Um, another thing another red flag was the poor track record. You always want to do your due diligence on what, especially in venture, or excuse me, especially in crypto, what did the token do upon funding? What's the nature of the deal? And we're going to get into the terms in just a second. But historically, the projects that they have invested in, what did those tokens, how did they perform following the investment by this company? And that leads into, so did the price go up? Did it dump? We saw kind of a lot of manipulation that happened with ICP back in the day. I remember when ICP was up to like $700 a token, and then it plummeted. It's in the, I think, single digit dollars, if not double digit. And ICP is a great company, great platform. I've done a couple Twitter spaces with that community, and it's a great community. But they fell victim to a lot of this venture funding dump. So you want to look at how did these investors, how did these venture firms handle the token following their receipt of that? What did the price do? Did it dump? Did it rise? And that leads into our terms. Another red flag: unfavorable terms, and that seems kind of that seems intuitive, like it should be common sense that doesn't need to be stated. But one of the things I mentioned as the current state is a lot of your normal terms for venture funding are going to be a split between tokens as well as equity. I would say if you get a venture firm that is either solely token focused, they only want to purchase tokens at a discount, I would say all signs point to they're going to dump on you. That might not be true 100% of the time, but the majority of the time, if it's a token only offering or terms, then you can expect price action to not be good and not work in your favor. So unfavorable terms. In discussions that I've had with venture partners in the past, you can typically judge the longevity of or the length of time that a firm is going to be invested based on their terms, based on their offerings. So if it's more towards equity, then you can plan on that firm being around for 3 to 5 years, because I've followed this long enough to see charts with metrics that at that 3-year mark, the value of the equity grows exponentially more than the value of the token. So you want to make sure that a venture firm is in it for the long haul, and typically that's going to be if they are more geared towards equity over tokens. Now, every venture firm, especially traditional venture firms, the reason why accredited investors are the only ones allowed to participate, or institutions and accredited investors are allowed to participate, is because typically they have a higher net worth, and they have the ability to, or they can have funds that are not liquid. So these venture firms are doing a ton of investments into these early stage Web 2 companies that that are having growth in the equity shares, but they are not like receiving dividends. They're not, they're not receiving immediate benefit in the form of at least monetary benefit. And so these venture firms, they invest with a time horizon of 3 to 5 to 10 years before they'll see a return on their investment. Now it will if a company IPOs, it'll be a large return. Um, However, they have a lot of their funds locked up in these illiquid markets. Now, what crypto did is it now has a token attached, so there's the opportunity for liquidity. Occasionally, these venture firms, they'll want liquidity, so most of the time they're going to do deals that are a combination of the equity and the tokens, so that they can have, provided that they need the liquidity for their firm, they can have the ability to sell some. And typically, what you want in your terms are the nature of selling, percentages that they're allowed to sell based on daily trading volumes, or they can only sell X amount. You want all of those things to be ironed out and written, um, so that it's clear and that you don't encounter a massive sell off. These are fun because you get really thirsty as you talk for 40 minutes. So you want to make sure that the firm, another red flag, is a misalignment of interests. If they are purely in it for the money, they will throw it at whatever has crypto or AI, whatever slapped onto it. You want to make sure that there's an interest there, that they can provide not just the financial benefit, that they can provide you this funding, but also that they can provide some sort of expertise, some sort of guidance, some sort of wisdom. Oftentimes, these venture firms, these were former founders of startups that that took off, grew quickly, and now they're doing the same. They're basically putting back into this industry, where they what that holds near and dear to their heart, that are startups. And so they have a lot of wisdom from the years of starting a company, growing it, scaling it. They understand the problems that entrepreneurs face, and they understand the right people to put in place, the right team to build around. In general, you want to check for any sort of reviews on a firm, and make sure that you know you've done your due diligence as far as Googling the companies. Big one is regulatory and compliance issues. Has this firm had any sort of um, uncompliant operations in the past? Have their founders been guilty of anything in the past? One of the things that I think is crazy is the discussions that FTX is making a comeback, and that people would actually fund this venture. We live in a backwards world. It's kind of crazy that is something that is even a discussion. So has the venture team encountered situations where they were not compliant with regulations? And then kind of a last red flag, at least in general for venture, is if they're trying to rush the process. You want a firm that is uh, confident, that they're not trying to rush you, that they want there's mutual benefit, that they want the best for the company, as well as they want a return, but they're not trying to rush the process, and kind of like the used car salesman that's trying to get you off the lot as fast as possible. So if they are rushing you through the process, um, and making you move too fast, or pushing you too hard, then that's typically going to be a red flag. So we've talked about terms, we've talked about or unfavorable terms, we've talked about um, compliance, and the young team or inexperienced team, even because one of those, when you get into this funding situation, you want to have partners that are alongside you, that they're with you, they're in the trenches, they're helping provide wisdom. And these young kids or young people don't typically have that same experience. They're not going to be able to give you wisdom and the guidance to actually take your company to the level that you want it to. They'll, another item is, make sure that they actually have sufficient funding, that they're going to have the runway necessary to give you the funding that you need, and that is outlined in the deals. Um, there are a lot of resources online that you can find to shed some light on that, especially in the world of blockchain. You can follow track records and wallets and things of that nature. You can also look to resources like Crunchbase or PitchBook or any of those. They'll be helpful in shedding some light on the different firms and the companies that they've funded. So, one thing you want to look for, a positive thing, is the long-term commitment. So we mentioned kind of those indicators for if it's a long-term or short-term commitment. And then the last kind of red flag will be portfolio diversification. If you have a fund that is, or a firm that is very isolated in one industry, and one industry, in one genre within an industry, if it's all DeFi projects, that's going to be a very risky situation for you as a startup and as a founder to get into a deal with a firm that is over leveraged in a sense, because let's say regulations go against the way of most of those DeFi focused projects. This company is going to, become insolvent. They're not going to be able to provide the promises of funds that they made. And so you want to look for, a firm that has a diversified portfolio that isn't as susceptible to, in a speculative environment, in a risky environment. You want someone that has a good diversification, with, even if it's solely crypto companies, within diversification within the industry. So those are, I spent a lot of time talking about red flags. We're going to kind of wrap everything up with the action items that, if you are a founder, that you should be taking if you're seeking venture capital. So a couple of them are kind of the opposite of what we just discussed. But any sort of venture firm or partner that is looking to fund a crypto company, the primary drivers, the number one and number two drivers for these firms. Number one is going to be team. They're going to look and see track record of team, experience of the team, maturity of the team. That's going to be, if you have a team that is that has high integrity, that has an incredible work ethic, that's high performing, then even though there might not be a product market fit yet, they're going to be able to, or they if they have a product that ends up not working out, they're going to be able to pivot and iterate. I think a lot of startups, they started with one vision, and then the reason why they were successful is because they pivoted, they iterated into their niche that ended up taking off. I believe, I'm trying to think of Slack. I believe it was Slack. Slack actually, the whole reason it started as a, it was a mesh. It started out, the vision was a game. So the founder, oh man, I'm going to butcher this, unfortunately. I think it's Mark Benioff, but I might be completely wrong on that. I probably am. So the fun of being live, and not having a Jamie like Joe Rogan does to fact check. But the founder of Slack, his original vision was to build out a game, and in the game they had a messaging platform, and what he found was that tech that was involved with this messaging platform ended up being that was the value. it wasn't the game, and that's not what took off. It was when they pivoted and decided to build out Slack and build out this corporate communication, this business communication medium, that they became a unicorn, $1 billion company, and are now publicly traded. So that was an example of a team investing in a team that was able to pivot, iterate, and become $1 billion company. The second primary driver is product and product market fit. Do you have something that the industry needs, and is it at the right time? So if your timing is wrong, it's as good as too late is, or excuse me, too early is just as bad as being too late. So is there a product market fit? So those are the things that these firms are looking for. So as a founder, you want to make sure, one, you surround yourself with a high performing and excelling team, and two, that you have a good product, and that you have found your product market fit. In the case of Galileo, we are specifically focused on luxury goods and the trustless nature of NFTs, and the ability for digital twins. Uh, um, that technology is what's very needed in this world of counterfeits. So if you're a founder, you want to build a strong business case, product market fit. You want to engage in networking like we did this past week at SmartCon. Go to these conferences. Don't go necessarily to pitch. Go to ask. Go to ask questions to learn about the market that you're trying to break into. Learn about your competitors. Go up and talk to them, and see what they're building, and see what's working and what's not. But networking is going to be essential as a founder looking to meet possible investors, as well as to continue evolving your product market fit. You want to be able to conduct thorough due diligence. That's kind of been if we have a theme for venture, it's due diligence. Make sure you're dotting your I's and crossing your T's. You want to seek legal and financial advice. There are lots of find a founder on LinkedIn that has sold a company, and ask him, hey, what are some lessons that you would have liked to know, or that you learned along the way that you wish you knew back when you were first starting your company, back when you were looking for venture funding. You want to make sure you identify the right partners. Is it someone? Is it a firm, or is it an associate or partner that you can call up on the phone, that you can easily talk to, where you feel that they are engaged, and that they're invested in the success of the company, not just for that return, but also that kind of relational component. Firms are gonna want traction. They're gonna want to see, is there revenue? If there's not revenue, again, product market fit. You want to maintain transparency as a founder. Hey, these are the trials we're having. These are the things we've tested and that didn't work. These are the things that I'm not sure. Sometimes an I don't know, let me find out, or I need to investigate further, is way better than just making something up. Make sure that you negotiate terms. Like, this is your baby. If you have built this company, if you're a founder, you want the most favorable terms as possible. Be willing to say no if it doesn't meet the terms and expectations that you have. And then lastly, with any partner or firm that you bring on, any venture firm that you bring on, you want to make sure that there's constant communication. Make sure that there's a relationship. Make sure that that you can have that wisdom and insight that they've gained over years and years of their own company and being in the venture space. So recognize that you're a person building a company, and make sure that there's mutual benefit there as well. So we are almost at the top of an hour. I think it's flown by, but also maybe it feels like it's gone very slow. If you are still listening, you are a trooper, and I applaud you. And thank you from the bottom of my heart for tuning in and listening to my musings and my ramblings. If you are a fan of this, if you think that this could be helpful to a founder that you know or a startup that you are aware of, maybe even that you're invested in, I would really love if you would like, subscribe. If you're watching on YouTube, subscribe to this YouTube channel. Make sure to follow us on Twitter or any of the socials, and repost this. Um, we love to gain some traction. Hopefully, if we can provide benefit to one founder, if this can be helpful to a single founder and in their funding journey, if it can give them the ability to say no, or the opportunity and clarity to know that it's an absolute yes, then we've done a good job with this podcast. So I'm grateful to everyone that has tuned in. uh, I hope we can gain a nugget of truth. Again, like, subscribe, follow, repost. And as we wrap up, because I think my voice is almost done, as we wrap up, please share your comments. If you're still listening, share comments below. If you're watching this on YouTube or you're watching this on X, formerly Twitter. We would love to know, is this content that you enjoy? Is it bringing value? As well, let's crowdsource. What would you like for us to discuss? What sort of topics would you like for us to get into on the Tech Frontiers X podcast? We want this to be a benefit for entrepreneurs, for investors, for founders, and we hope we can add some value to this industry, and maybe even provide some wisdom and insight and clarity where there wasn't before. So I think we've come to the end of our podcast. I am incredibly grateful to y'all. I appreciate you, and I think most likely you will be back to your normal programming with Pierre next week. I've had a blast getting to talk about venture, getting to talk about SmartCon, and all that's going on at Galileo. So I hope that you will tune in next week, and hope you've enjoyed this episode of the Tech Frontiers X podcast. Again, my name is Zach Atkins, and everyone out there, stay classy, and y'all have a great week.